Welcome to my new tutorial. Today I'll be discussing about financial modeling and I'll discuss the key strategies for making effective financial models and financial projections. The learning outcomes. Introduction to financial modeling. Core components of financial models. Building financial model in Microsoft Excel. And what are the various techniques we can use in MS Excel in terms of financial modeling. And what can be the best practices when developing financial modeling. So the definition and purpose of financial modeling. Basically, what is a financial model? Financial model is just like a mathematical framework in which we have to input some information and then the mathematical framework processes that inputted information, transforms it, and gives us an output. It's just like an equation where we have some numbers, we plug in the numbers into the equation, and then that equation, we solve it, and we get a result or an output. Uh, the purpose of financial modeling is basically, first of all, the performance analysis that we want to evaluate our performance, the performance of the corporation, and then it has to relate with the present and previous times, but it also has to relate with the future, how our performance will be in futuristic terms. And that is doing the forecasting, that we forecast our performance in terms of future. And then on basis of that uh, forecast, we are there to conduct some decision making and we formulate strategies. So that decision making and strategy formulation is taken into consideration the predictions that we have made as a result of our financial model. So what's the importance of financial modeling in decision making process? Number one is financial models enable us to assess the emerging risks. Because when you are doing forecasting, you have to consider various external and internal risks that may affect the performance of your corporation. Number two is you are able to evaluate various investment options that you have considered emerging risks and you have various options. So you are in a better position to evaluate the prospects for making future investments and to weigh the pros and cons of various investment projects. And number three is supporting strategic initiatives. Because when you conduct modeling, then that financial modeling gives you a snapshot about the possible scenarios in the future. And that enables you to make various decisions related to in formulation of strategies. So that is the relevance of financial models in decision-making process within an organization. So to conduct financial modeling, the most widely tool that is used is Microsoft Excel. And the reason for using Microsoft Excel is number one is the flexibility that MS Excel offers that enables us to customize our models according to changing needs and scenarios. Number two reason is that Microsoft Excel provides powerful functions that can help us to do the calculations and data analysis which we need in financial modeling. And number three is that it has a dynamic uh, ability to with which we can update and modify the financial models according to changing data and needs and requirements. The most important thing in a financial model is inputs and assumptions. Inputs you can understand its importance by the term garbage in, garbage out. That whatever input you do, the financial model will process that input and will transform that input into output. Financial model can be understood like a machine that takes the input, transforms it, and gives you output. So if the input is not right or it's uh, not good enough, then whatever output you will get, that will also not meet your requirements. So the input has to be very selective. The input has to be very uh, related to what your desired results are. So then the assumptions that when you are selecting an input, then you have to make certain assumptions. So think of like your aim to make a, a smoothie, and you want a smoothie just made of strawberries and kiwis. So your assumption can be that you just want to avoid uh, fruits which are high in sugar. So that can be your assumption. Your desired result is make a smoothie which is not very high in sugar. So you have chosen strawberries and kiwis, which are low in terms of sugar. And then you use a blender. So blender can you can assume the blender as a financial model, which transforms your input. So inputs have strawberries, kiwi, and water. It doesn't have sugars because due to your assumptions. So assumptions have that role that you have to select input based on your assumptions. And then whatever input is being used, the output will be according to your input. So if the input doesn't have much sugar, then the output, that is the smoothies, will also not have enough sugar. So that is the relevance of inputs and assumptions in a financial model. Then importance of accuracy, that whatever you are using an input, it has to be accurate. That if you are saying that you are going to make smoothies for strawberries and kiwi, then it has to be strawberries and kiwi. It shouldn't be strawberry powder. It should be real fruit. It can't be just uh, syrup of strawberries or syrup of smoothie kiwis. It has to be real fruit. So the input has to be accurate. And then whatever assumptions you are making and whatever ingredients you are using or input which you are using, there has to be a proper documentation so that everyone understands that, okay, so this was your input, this is the real ingredients based on those assumptions. And then so that everyone knows that what is the input, what is the assumptions, and that's the reason why you have got that sort of output or end result. So when it comes to corporations, we have to see whether our corporation, how it's performing now, how it has been performing in the past, and how it will perform in the future. So we have to estimate uh, the future performance. And for that, we have to forecast the revenues and expenses which we find in the income statement. So income statement, which is basically revenues and expenses. So we look at how how much our revenues had been during the current year, how much had been our revenues over previous years, and based on that, what we expect the trajectory to be in terms of our revenues in future. Likewise, we look at what are the current expenses which are reflected in the current income statement. What were the expenses during our previous years? And based on that, what will be the possible expenses in futuristic terms? So we have to estimate based on historical data, but just the historical data is not a good enough basis for making a good financial model or doing the financial projection. We also have to consider the market trends uh, and the business strategies because the market trends keep changing. So whatever the financial performance our company is doing now or was doing previous year, that can be influenced by different market conditions, different economic conditions. But in future, the market conditions may change, the economic conditions may change. So that can have a different impact on our ability to have revenues in future. Likewise, the market trends and economic conditions may adversely or favorably affect our expenses. Uh, Similarly, the cash flow analysis that how much cash flows we are generating now, how much cash flows we've been generating in previous times, and how much will be the cash flows in the future. So those things we have to consider while making forecast. So as you all know, financial statements can be income statement, balance sheet, and cash flow statements. Income statement reflects the financial performance, balance sheet reflects the financial position, and cash flow statement reflects the amount of cash flowing into the company and amount of cash flowing out of the company. So when making a financial model, we have to uh, consider that we have to do an overview about the income statement, that we have to look at the current income statement, the previous income statements relating to previous years, and then we have to make a forecast about the future projection of the income statement. Likewise, we have to make projection about the balance sheet, and then we have to make projection related to the cash flow statements. So historical data that has to be linked with the present uh, terms data, and then we have to do the projection. But while doing the projection, we also have to consider the internal market, internal conditions within the corporation. Then we have to consider the external factors like the economic conditions, the market conditions, and then we have to come up with a projection which takes into account the various risks, the various emerging risks, the market conditions, and the economic conditions, and the internal situation of the corporation. So when you are setting the spreadsheet for the financial model, you have to consider that your financial model should have the clarity and simplicity so that every user is able to use the financial model effectively. For that, you should have developed separate tabs for separate functions. So there has to be separate tab for taking the input. Then there has to be a tab for the calculations, that is, the transformation. And then there has to be a separate tab for the output, which gives you the result. Also, you should ensure that your financial model is easy to modify and it is flexible enough to take new updates into consideration. And when there is upgradation in data or in assumptions, so financial model should be able to tailor according to the changes that are happening and update accordingly. So that is why whatever financial model you have created in Microsoft Excel, that financial model should be linked to the financial statements of the corporation so that whenever there is any change in the financial statements in terms of numbers, or if there is any change in the assumptions, then that is updated immediately and reflected in the financial model. So the numbers may change or the situation, the financial situation may change within the corporation on a time-to-time basis. So your financial models should be capable enough to identify those changes and modify and update accordingly. So there has to be automatic updates. There has to be uh, the changes that should be reflected in the financial model based on the interdependent variables. What I mean by interdependent variables, that for example, if in a financial statement there is change in the overall expenses, then as you might be familiar that if there is change in the overall expenses, then the profitability is affected due to that change. So if there is change in the expenses, then as a result of that, the net profit or the operating profit is immediately affected. And when that is happening, then those changes shall also reflect in the financial model. So in terms of forecasting, we have to consider various risks that can happen in future that can affect the profitability or that can affect the financial position of the corporation. So there has to be risk assessments. That is, if everything is very favorable, then what can be our profitability in that scenario? If things are just as they are today or in previous times, then what can be our financial outcome or profitability? And if things are really very favorable, more favorable than what we are in current times or in previous times, then what can be our profitability? So we have to build a financial model and we have to predict the financial outcomes based on the scenarios. The scenarios can be pessimistic, normal, and optimistic. So, and on that basis, we're going to make the financial models and make informed decisions while considering the possible risks and scenarios. So, how can we use Microsoft Excel in making financial models? So, Microsoft Excel offers us the ability to use functions and formulas. So, we can build some functions and formulas for the financial modeling. We have a function named VLOOKUPs. We can use if statements and index match for effective financial modeling and data analysis. So in terms of building the financial models, we should be familiar with various functions and tools available in Microsoft Excel. So when we make a financial model, we want to make sure whether our financial model is meeting our requirements, whether our financial model is correctly transforming the inputs into outputs, whether it's giving us the desired results or not. So in a financial model, we should have a error checking mechanism. We have to validate the data and we have to identify if there are any errors. Uh, for data validation, we have to make sure we have proper checks that if the financial model has to uh, take the input, so it selects the right input. And then whether that input that is being taken, selected, it is being properly calculated. And if there is some discrepancy, there has to be visual cues. That is, the information should highlight if this information is not correct. Take the example of a calculator. So if you just write a calculator in Microsoft Excel and there are two numbers that have to be added, for example 5 and 6. So if Microsoft Excel, the calculator, takes the number 5 plus 6 and adds them correctly and gives us the result as 11, then it means our calculator is working fine. But if the calculator is taking incorrect numbers, maybe taking some information from cells which have non-numeric data, then definitely our calculation will be incorrect. So there has to be error checking mechanism. There has to be data validation that correct input is being selected. And then if there is some discrepancy, so it shall highlight with certain colors or highlighters. So basically, financial modeling is a repetitive task. That is, during every financial model, the process is that there is an input, that input is processed, and then there is an output. Just like a calculator, that calculator uses the input, calculates it, and gives you output. So every time the calculation is the same. If you are doing addition, so you can be doing addition with different numbers, sometimes 2 plus 2. In other round, you will be doing 2 plus 5, 5 plus 2, whatever. So the task is repetitive. So in a financial model, the task is repetitive. You have to select the input, you have to process it, and you have to give an output. So for that, Microsoft Excel has a function called macros, and that really helps to automate that repetitive task. That the same process you have to do again and again. So macros, with macros function, you can just use that to perform that repetitive task. And the benefit of that is that it minimizes errors and it leads to higher efficiency in terms of financial modeling. So you have to ensure that your financial model is giving correct results at different times. So you have to keep checking the accuracy of your financial model, and you have to maintain that. So you have to make sure whatever formulas you are using, those formulas are intact. Your formulas are still the right ones, and they are doing the right calculations for you. And there is regular testing of the financial model. Because if you have different results at different occasions, then that will lead to inconsistency and will be just, you'll be losing trust on the effectiveness of the financial model. So it's important to build trust that you have the consistency in giving the right calculations, right output related to your financial model. So apart from building the financial model, there has to be proper documentation and effective presentation. By proper documentation, I mean that whatever assumptions you made, whatever the scenarios you considered, whatever the emerging risks you considered for coming up with that financial output, it all has to be documented. The process of financial modeling has to be documented. How the input, from where the input is being selected, what is the source of your data, how the data is processed, and what is the output, what are the various factors that may have a positive or negative impact on the results from the financial model. What is the level of consistency and what are the checks that you have taken into account to ensure that your financial models are consistent and giving the accurate results even after uh, even during different time periods. And then you have to uh, present your financial model to the decision makers to uh, make them understand the relevance of financial model in their decision making. So the financial model, as I mentioned earlier, it has to have the feature of getting updated based on new information, uh, changes and updates in numbers, or changes and updates in the assumptions. So the financial model has to be linked with the current financial statements or the data related to current or emerging changes, so that the financial model remains relevant. If the financial model is not being updated with new uh, changes, then it will lose the relevance. So to keep it relevant, it has to keep updating. So all the changes shall be reflected, and the model shall have the capability not only to identify the changes, but also the model shall update its transformation according to the new developments. So that concludes our discussion related to financial modeling. In this tutorial, we covered about the importance of financial modeling, that when we are developing financial models, we have to consider various factors. We have to build financial modeling models related to various scenarios and emerging risks, and what is the relevance of financial modeling in decision making. Then we discussed about the various tools and techniques we can use in Microsoft Excel to make effective financial models, and then the best practices in financial modeling, where we have to keep checking the financial model so that the financial model is relevant and effective, and then the financial model that has to be updated according to the new information and uh, emerging changes. So those things we covered in this tutorial. Thanks for watching. Please don't forget to like, subscribe, and share my channel, Academic Visions. I'll see you next time with a different topic and a different lesson.